Our next testifier will be, again, from the said business school. Dr. Ludovic is here, and from the University of Oxford. Dr. Ludovic is an author of many texts and dealing with private equity, and he teaches management and private equity. He's got a master's degree of mathematical finance from the University of Southern California and a PhD from INSEAD. Dr. Ludovic, we very much appreciate you being here today. I'll just take another moment to recognize one of our colleagues who has joined us today. Representative Brett Miller is here, and he has got a piece of legislation in the House of Representatives that has to do with transparency and reporting. We're happy for his work in the pension arena, and happy that you're joining us here today, Representative Miller. What House bill number is that? HB House Bill 1460 of 2018. So take a look at it. It's an important piece of legislation. I think it was voted on unanimously by the House of Representatives and awaiting action in the Senate. Thank you very much, Representative Miller. Great. Dr. Ludovic, thank you so much for joining us today, and we're anxious for your testimony. Thank you.
Thank you. Thank you very much for having me. I will talk about the costs and benefits of investing in private equity funds. Private equity funds are investment vehicles in which the two PA pension funds have invested a total of $40 billion in over the last 25 years. They received $62 billion back from these funds, which coincide with a rate of return of about 11% per annum. And for this, they have paid an estimated fee of $12 billion. Fees have not always been reported to pension funds, and this may explain partly why no pension fund has reported the actual amount of fee it has paid. And this is why this $12 billion is an estimate, and this is why, despite this estimate being probably on the low side, $12 billion is much higher than the officially reported number. For instance, over the last 10 years, the total fees reported in private equity by the two PA pension funds sum up to $2.2 billion, while my estimate is that the actual amount was $6 billion. Again, this is an estimate. It is based on extensive academic research I have conducted over the past 10 years, but I have had access to only very limited data on the PA pension funds. People at the Treasury have requested a number of documents to the PA pension funds that would have helped to compute a more accurate number, but these requests have all been denied. This situation is common to all the pension funds in the world. It is not unique to the PA pension funds at all. And this point has been made by many other people. For instance, an excellent cartoon I'll show you in a sec, which appeared in a magazine called Institutional Investors, and illustrates that very point very well. So we could see maybe the slide on that cartoon. However, some pension funds, most notably in the Netherlands, are now required to report the actual total fees they pay. Public pension funds in California and in some other American states have also very recently been required by the legislator to report more of the fees they pay, even though it is not always all of the fees they pay. Many people argue that the amount of fees paid is actually irrelevant because private equity funds deliver high returns after all the fees. I've been hearing this argument since I started researching this field 15 years ago. To evaluate this argument, I will both think about it theoretically and empirically. First, theoretically, and starting with fundamental theory, a large body of research in financial economics has taught us that you should always get what you pay for. There are very few, if any, good deals out there. Good deals are basically investments paying you more than the fair returns. The idea that an anti-industry could offer a good deal for more than 15 years puzzles any financial economist, who necessarily reason that if private equity fund managers can generate high returns, why would they not keep the excess returns to themselves? In other words, why would fund managers not just increase fees to the point where excess returns are gone? There is always a level of fee that is high enough to turn any great investment into a fair one. And even if fees do not move, there is always a level of capital flows that is large enough to push up prices to turn a great investment into a fair one. The usual response to this theoretical argument is that private equity funds need to share excess returns with their investors to compensate them for private equity investments' illiquidity and higher risk. If an investor is more tolerant to the liquidity and risk of private equity funds than the average investors out there, then it should invest in private equity because it will earn these compensations while not caring much about the associated drawbacks. Virtually all the pension funds, endowments, and sovereign wealth funds I know of, and a few, argue that they have a long horizon and as a result do not care about illiquidity and higher risk. As Tim just said, illiquidity is highly overrated. And as a result, they reason that they should invest in private equity in order to earn this illiquidity premium. But if such a massive amount of capital does not care about compensation for illiquidity and risk, then it is less likely, at the very least, that these features would be rewarded with higher returns. An excess return can only be rewarded if enough people care about the associated drawbacks. That's just slides to summarize what I've just said. There are two important theoretical arguments that could actually make matters worse. First, there were basically no rules for presentation of private equity funds track records, and there are still very few rules. As we know from extensive research on mutual funds, it is relatively easy to window dress past performance to make it look better than it actually is. Research on investment consultants from prominent scholars, such as Professor Jenkinson at Oxford, who you just heard, and some observations of fundraising prospectuses from private equity funds indicates that it is a widespread phenomenon. If investors are influenced by window dress numbers, then there would be excessive capital flowing into private equity funds, and that could push returns below fair value. Second, you could show the other side. Second, it is a lot more interesting to invest in private equity than in any other asset class. Private equity is a fascinating hands-on investment approach. It is highly rewarding to travel, to visit actual investments, to hear from very clever people who invest and run actual companies. Investing in stocks and bonds is extremely boring in comparison, especially if it is done via so-called passive strategies. As a result, at the margin, investors may be tempted to over-allocate to private equity, which might also push expected returns down. This said, so that would be the next slide. This said, private equity may offer important diversification benefits, especially when one considers the reduction in number of publicly listed stocks. In addition, if an investor is able to select above average fund managers, then these investors can obtain excess returns, of course. More generally, there are many different types of private equity funds and investments, each with different costs and benefits. It may be also worth pointing out that ESG initiatives, environmental, social, and governance initiatives, ESG, for example, are more impactful if executed via private equity. Hence, overall, I think that the case for investing in private equity can be made in theory, but it is not a simple case. The usual argument saying that if I need high return, therefore I invest in private equity because I will earn an illiquidity premium, lacks theoretical soundness, to put it mildly. How about empirical evidence then of existence of excess returns? First, we need to avoid window-dressed figures. The industry is nearly always showing so-called internal rates of returns, IRRs, which are presented as rates of returns. But IRRs are close to rates of returns only in some very specific cases. Therefore, we should ignore the recurrent claims that some investors or funds earned 30% or more over long periods of time in private equity. These numbers are all IRRs. For example, the endowment is world famous for its investment in private equity funds, and it is often said that it earned a spectacular 30% per annum in private equity. Its latest annual report is available online and shows that its investments in LBO funds, which is the largest type of private equity funds, returned 9% per annum over the last 10 years and 13% over the last 20 years, which are not numbers that are not far from what we see from the pension funds here. Well, it is clear that some LBO fund managers have become spectacularly rich over the last 20 years, integrating the Fortune 500 list. It is less clear that investors have had an equally spectacular fortune across their entire portfolio, at least as far as LBO funds are concerned. But how much did investors actually earn overall by investing in LBO funds? The landmark study on this issue is that of Bob Harris, Tim Jenkinson, and Steve Kaplan, published in the Journal of Finance. Data are as of 2008, and they find that US LBO funds basically outperform by 3% per annum. A few remarks. First, note that this is the most accurate estimate we have as of 2008, and it is likely to be slightly optimistic because investors who gave the data consented to the data being shared for research. These investors might be more advanced than the average investor in private equity that are backfilled, and it was a US-only sample. But hopefully, these biases are negligible, and there are reasons to believe that they are negligible. Either way, this is the best data academics have access to. Second, note that some costs are not included. Due diligence, legal advice, currency management, illiquidity and credit line management, higher investment risk, higher government risk due to the lack of control on underlying investments and on the ultimate fees and expenses charged by fund managers, etc. All of these are costs for the pension funds that are not included. But maybe they are all negligible as well. Third, note back that in 2005-2008, most investment presentations, be it for gold or for private equity, was using the S&P 500 as a benchmark. Coincidentally, perhaps, the S&P 500 was one of the worst performing stock indices back then. It was not the only one. Russell 3000 and 2000 indices also had poor returns and were also very popular benchmarks. You can maybe see that. And then another one. Let's look at more recent history. Over the last 10 years, using the same comprehensive data set as that of Harris, Jenkinson, and Kaplan, I find that private equity funds have had basically the same returns as the S&P 500, as shown also in the previous presentation. Similar results have also been derived using other data sources by other people, like PitchBook or CEM. One interpretation, which we have just heard, is that private equity has returned as much as listed equity because too much capital went into private equity over that decade, and that returns have compressed as a result. It is a possible story. There is another possible explanation, though. From 2008 to 2007, the return of the S&P 500 index has been exactly equal to the return of the average listed stock. And the average listed stock had strongly outperformed the S&P 500 over the previous 10 years, which means that over the last 10 years, just like over the last 10 years before, private equity just matched the return of the average listed stock. So maybe in a graph, you may see that better. You have here the S&P 500 plotted from early 90s to 2007, and you see how the average stock in the US has outperformed the S&P 500, mainly in the early 2000s, which is exactly when private equity outperformed the S&P 500. Private equity returns basically match extremely closely the ones of the average stock here. If we go to the next graph, at the next decade, these two lines are basically undistinguishable, and that's the S&P 500 versus the average stock in the US. And therefore, again, private equity performing in line with the average stock performs therefore now in line with the S&P 500. As an aside, over the last 4 years, the S&P 500 has disappeared from many investment presentations. And the MSCI World Index has appeared instead. Coincidentally, perhaps, the MSCI World Index is one of the worst performing indices over the last 10 years, mainly due to the underperformance of emerging markets. It is therefore important to be aware of strategically chosen benchmarks. But let's accept that private equity funds returned 18% gross of fees, charged an estimated 6% a year, and returned 12%, and that public equity returned only 9%. Let's also assume that private equity will continue to deliver twice as much as public equity before fees going forward, which is basically what happened in the past. I think it is not controversial to assume that expected returns are currently lower than past returns for any asset class. If private equity will deliver if public equity will deliver 5% and private equity does twice as much, i.e. 10% gross of fees, then after fees, this 10% will be a 5% going forward, simply applying the average fee structure that is currently in place and has been agreed to. Which means that even if private equity would continue to deliver twice as much as public equity before fees, which is extraordinary, in a low return environment, given the existing fee structures, investors might earn or might find difficult to earn even as much with private equity as they would with listed equity after fees. The bigger point is that the enduring belief of great past performance, mostly based on a misleading return metric, IRR, means that a lot and perhaps too much capital has gone into private equity, and any serious conversation about reducing fee levels and having better alignments of interest has not occurred. Perhaps, as a consequence, many large asset owners have aggressively pursued various alternative strategies to access private market investments, which basically consist of reducing the reliance on traditional private equity funds. To conclude on the empirical evidence, past performance has not been bad overall, but it has not been this large outperformance many people invoke when justifying private equity investments. Yet, private markets have an important role to play in asset owner portfolios, not least because of the decaying role of public markets. But if people base their investment decisions on false information and statistics, they will not obtain what they are hoping for out of private markets because they will not have a bargaining power to negotiate the contracts. And this is why transparency and honesty are paramount. As mentioned earlier, many people actually argue that if we like the soup, we don't need to know the recipe. Fees are therefore irrelevant. Performance net of fees is all that matters. I disagree. First, because future performance is uncertain, but most of the fees are certain. Knowing how fees are computed better informs us about expected net of fees returns, which is what we ultimately care about. We don't care so much about what happened in the past. More accurate expectations should lead to more balanced negotiations and better outcomes for the asset owners. Second reason why I think it matters is that we may care about fairness. In this case, we may care to know how much was paid in total to private equity funds to compare with what they have delivered. In the case of the PA pension funds, it is at least 12 billion that was retained by private equity funds to deliver 11% per annum. Some will find this fair, some not. But there cannot be a debate and an endorsement without knowing the actual figure. It is my belief, and the conclusion I draw from 15 years of extensive research in this area, that we ought to care about how much fees are paid and about how good or bad past performance has really been. There ought to be a transparent and honest conversation. Active mutual fund managers, for years, argued that no one should look into their fees and potential for conflicts of interest. They resisted regulation because they said investors should only look at the net of fees returns. An active mutual fund today that would use this argument would be shown the door anywhere and very quickly. For the health of private markets, of the many great private equity fund managers out there, and the many pension funds, executives, who want to do the very best they can for their pensioners, and there are many of them, I believe that we ought to apply the same standards of transparency and performance reporting to private market managers as we do to public market managers. Thank you very much for listening, your attention, and I want to particularly thank the Commission for this very important endeavor that they are undertaking, and also the people in the room, the journalists, the people working for the pension funds. Everybody is working for a very noble cause. So thank you, everyone.
Thank you, Dr. Ludovic. I've noticed from looking at your biography and reading some of your work that you've also worked with the CalPERS system, California system. Can you compare the information that you've received and the work that you've done in analysis with Pennsylvania and the California system?
I haven't been hired by CalPERS, but I was highly involved with the discussions that occurred at CalPERS on this very same topic a few years back. it was in an indirect way. It was by helping some people who are on the board of CalPERS to ask the right questions and to help the journalists to write the right story, which ultimately led to a change of legislation in California that asked for more transparency. And it might or might not have led to the change of the person in charge of private equity at CalPERS. The situation at CalPERS is virtually identical. The performance is exactly the same one. It is actually fairly fascinating that about any big public pension funds in the US has the same return in private equity. It's about 1.5 times the money they got back. And therefore, the fee bill is basically always in the same order of magnitude, which is about 1/3 of the money that has been given to private equity funds has been taken as a fee. The situation at CalPERS has been very similar. About the data that CalPERS has provided me with, a while back, before these discussions, for my own research, for one paper, I had asked via a Freedom of Information request for their detailed cash flows on all the funds that they invested into. And within a few weeks, they sent me 700 pages PDF document with all of this information, which was processed and was very helpful for my research. I note that apparently the commission here, or the treasurer, has tried to ask the same information to the PA pension funds, and they said that they couldn't provide this information. So indeed, CalPERS, for example, without even a commission or treasurer or anyone, just a regular academic just saying, for my work, I would like this information, gave it pretty quickly and in great details.
Thank you. Mr. Vice Chairman, you have a question?
Thank you, Dr. Falpu. Can you go over the math of, you said in the last 10 years, you estimate fees in connection with PE to be a total of $6 billion, of which $2.2 billion have been reported.
That's right.
Meaning that in your estimate, there are 3.8 billion in fees that have not been reported.
About 2/3, yeah. The fees are basically almost always about half-half between carried interest and management fees, roughly. Carried interests are not reported. And for the other half, the reason why it's not fully reported is because a number of fees are taken directly from the assets that the fund have bought on behalf of the pension funds. And some of this money is rebated against the management fees, which means that the management fees are not called from the pension funds. And the pension funds then take the view that if they are not called for fees, then it is as if they hadn't paid them and therefore not report them. So that has been one of the big sources of the discrepancy between what has been reported and what has been actually charged.
I actually wanted to ask, and that's a staggering number, 3.8, but is your view that that's money coming that would otherwise go to the beneficiaries of the fund? I mean, are those really fees? Or there are people who say those aren't fees, and there's something different.
That's correct. Now if you would have negotiated that private equity fund managers work for free, then you would have got $6 billion over the last 10 years. They wouldn't have accepted that contract. But I think it is important to have indeed that magnitude in mind in comparison to the returns. Also because we just heard it, people tend to think that carried interest is okay because you pay only if things are going well. The argument is more subtle than that. The situation here, for example, is that there's, let's say, only 11% net of fees returns, and there is more than $6 billion of carried interest for the entire length of a program that have been charged. So how come one gets $6 billion for having delivered 11%, which is not that far from the 8% hurdle rate? And the reason for that is that the contracts are symmetric. So you give 20% of your profits to all the fund managers that have outperformed, but the one who underperformed do not give you anything back. Which means that you can have a portfolio where you have two managers, one doubled your money, one lost everything. The one who doubled your money keeps 20% of that, and the one who lost everything doesn't give you anything back. So overall, you have lost money, and you have paid a massive carried interest, and yet you have lost money. So the carried interest bites in a lot more than people usually assume because you distribute it to all of the people in your sample that have done well. So the fees are more than what often people think. And so having the real numbers like this enable people to be better equipped to have the right conversations. And also when thinking about a different model to invest in private markets, it equips them with thinking the right way about another model.
Thank you. I want to be mindful of your time also, but Commissioner Gallagher, you've got a question?
Thank you, Mr. Chair. Yes, thank you for being here. I've learned a lot personally from the book that you wrote, Laid Bare, Private Equity Laid Bare. And I find it to be a very approachable way to understand the mechanics of private equity, and thank you for that. You've made it more understandable. Actually, the treasurer already just asked the question, but I think I want to better understand in a different nuance to the understanding of carried interest. There are some camps that will call it profit sharing, and some camps that will call it a fee. And I appreciate you saying that there is this time where if they don't perform or underperform, they still get paid. Now, that doesn't sound like a very equitable deal, but can you help dispel which way or the other? Is it profit sharing or is it fees?
So indeed, there has been a pushback on the notion that carried interest should be treated as a fee. The definition that I think most academics would agree with on what constitutes an investment fee is that if the fund managers that you have hired to manage your investments wouldn't have earned anything on the investment, how much more would you have taken home? If that's the definition of fee, then the carried interest is a fee because the manager earns it. If you go on the annual reports of Blackstone, KKR, who are publicly traded companies, the largest private equity fund managers in the world, they will have a chart showing you their revenues, and they will say revenue line number 1 is carried interest, revenue line number 2 is management fees, revenue line number 3 is portfolio company fees. So if you go to private equity fund managers, they will tell you I have 3 sources of income, and here they are. So why would 2 of them not be called a fee? I've heard the argument as well that because they just keep it on from the distributions, then you haven't paid it, so then it shouldn't count. Imagine that Vanguard has your money on your 401k, and whenever there are dividends paid by the stocks they hold on your behalf, they keep this dividend and tell you, don't worry, I don't charge you any fees. Would you not treat this retaining of dividends by Vanguard as a fee that they have charged you? So I think that if we go for the definition that a fee is what the manager has taken from the investments directly or indirectly that otherwise would have come to you, then carried interest is a fee. Just like if Vanguard was keeping all of the dividends of the stocks they have on your behalf, that would be a fee.
Yes, I appreciate that. I think when we conflate different analogies, it can really go down a spiral of confusion. I think we guys just stick to private equity because we ventured into a very different industry with different federal and state laws associated with it. So if we can just stick to private equity. So can you just clarify, I mean, you gave me some examples of underperformance, but when they do perform and there's alignment of interests, what is it at that point then?
Yeah, so the subtle point that has hardly ever been made, and I wrote an op-ed in the Financial Times this summer to make it. Not everybody understood that apparently, but so I will insist on that point. The example, I'm going to repeat the example I just gave. Imagine you invest into 2 private equity funds. You give 100 to each one of them. One generates 200 with your money, and the other one loses your 100. The one that has generated 200 with your money will keep 20 as a carried interest because it generated 100 profits. Therefore, you as a pension fund, you end up with 180 back from the good manager, 0 from the bad one. So you gave 200 to the industry, and you got 180 back. So you have lost money, even though all of your contracts in my example were performance-based. And the reason is, this wouldn't happen if people underperforming would give you 20% of what they have lost, right? So if you had a contract which is a bit like a derivative contract, whereby there would be a margin account, and when you start losing money, people put collateral for the 20% that they would virtually owe you for having lost some of your money, then that wouldn't happen. So one of the hidden costs of carried interest is also that in a diversified portfolio, you may be in a situation where you have paid a lot of it without having had overall a very good performance.
Yeah, I hate to consume so much of the time, but just one last question. When we look at private equity versus public equity, the barriers to entry are different, right? And the costs associated as such. So buying a stock can be purchased on a cell phone versus buying a private company. Can you talk about why there are some embedded costs associated with each, as far as you understand it and practicum?
What do you mean by embedded cost? That you mean that the cost to do private equity is much higher for the private equity fund manager?
Yeah, just swimming through the legal papers and getting through to actually purchasing the underlying asset.
It is an extra. If what you allude to is the fact that when I say 12 billion of fees have been paid, it doesn't mean that people walked home with 12 billion, because it's an extremely expensive business to run. So this is not 12 billion of profits that the private equity fund managers have made. That said, a lot of billionaires have been made from being private equity fund managers. It is not profit because it is indeed an extremely expensive type of investment strategy. So it is normal that the fees and the costs are going to be a lot higher. But we do not know, because we do not have access to this data, how much profit private equity fund managers do. The only ones we know is the ones that are listed, like Blackstone, KKR, etc. They seem to be doing pretty well. But we don't have a good sense of overall how much profit people make. The small funds do struggle with this kind of fee structure. Like Tim said earlier, if you have 100 million funds and you charge 2% management fee and a 20% carried interest, you're not going to be very rich with that.
Thank you. Thank you again, Dr. Ludovic. We appreciate you being here, your testimony. We appreciate you're here on behalf of all of the pensioners in the Commonwealth of Pennsylvania and taxpayers as well. So thank you for your testimony. We've gone a little bit over, and I'd like to ask if we can just convene at 12:55 is when we would like to convene. But our next testifier is Craig Lazaro. Is he with us here? Craig, is it okay if we start at 12:55? Are you comfortable with that? Great, very good. We'll convene again at 12:55. Thank you.